Thanks for joining us today, and welcome to the Financial Data Exchange's quarterly webinar series. My name is Tom Carpenter, and I serve as the Director of Public Affairs and Marketing for the Financial Data Exchange. The goal of these webinars is to explore issues pertinent to consumer permission data sharing and the financial services ecosystem. For those of you unfamiliar with the Financial Data Exchange, or FDX, we're a nonprofit organization dedicated to promoting a secure, common, and interoperable industry standard for financial data sharing. Our members include financial institutions, fintechs, consumer groups, industry associations, financial data aggregators, and many other financial services-related companies and organizations. Put simply, FDX is seeking a better way for consumers to share, use, and leverage their own data than the current method of held-away login credentials and legacy data access models. In fact, FDX believes that universal adoption of the FDX API will move the entire financial services industry to a much more secure, consumer-centric, and transparent data sharing environment. If you're not yet an FDX member, we would love for you to join us. The FDX API spec is free to download, and for more information, please visit our website at financialdataexchange.org. Also, please be sure to follow us on Twitter at FDXorg and on LinkedIn at Financial Data Exchange. Now on to today's webinar. The COVID-19 crisis has been a tragedy all over the world. Hundreds of thousands of lives lost, and even more survivors who currently face a daunting road back to recovery. There are millions out of work, and businesses large and small have shuttered permanently. This crisis has also upended every aspect of what used to be normal life. Rhythms and routines we used to all take for granted, like enjoying a meal out to eat or traveling or interacting in close proximity to friends and family, have all changed. In the same manner, the way we access and use financial services has been significantly impacted as well. Here are just a few stats to consider. According to an April survey conducted by investing firm Betterment, 52% of U.S. consumers believe they'll need to tap into their long-term savings in a year or less. In a similar survey in May, Fidelity found that 60% of respondents reported being concerned about their finances. This includes 69% of millennials, 68% of Gen Xers, and 51% of baby boomers. Concerning fintech, just a week into the COVID-19 related lockdowns and social distancing in March of this year, independent financial advisory firm the DeVere Group reported that the use of financial apps increased by 72% across Europe. Banking has also seen tectonic shifts. Regarding branch-based banking, a recent survey by Simon Kucher and Partners found that 42% of respondents said they will reduce branch visits after the lockdowns end. And yet, in an interesting twist, 65% of these same consumers said they would move at least some of their businesses to a new bank if their primary bank's local branch were to permanently close. And with many bank branches shuttered, mobile banking has seen a dramatic increase as well. According to a survey from core technology provider FIS, mobile banking registrations in early April surged by 200%, and mobile banking traffic rose by 85%. Finally, the way we pay for things has changed. In another FIS survey in May, 45% of the survey respondents said they are now using a mobile wallet of some type, and 31% of respondents said they plan to use contactless or mobile wallet payments instead of cash and checks. In sum, all of these stats point to one conclusion. COVID-19 has had a significant impact on consumer behavior and expectations for financial services. But this conclusion naturally leads to the next question. What do all these changes mean for the future of financial services? This is the question that we'll be wrestling with on today's call. And thankfully, we have some very distinguished panelists who are going to help us find all the answers. That said, at the end of our panel today, we will leave some time for audience Q&A. So if you do have a question, please submit it to me privately with the chat function found at the bottom of your screen. Now let's meet our panelists. First, we have Christina Tatro, who is the Manager of Financial Policy for Consumer Reports. In this role, Christina leads Consumer Reports' day-to-day policy efforts focused on financial fairness, consumer protection, and consumer empowerment. Next up is Bill Trapanini with Enterprise Engineering, or EEI. Bill is EEI's Executive Vice President and Chief Revenue Officer and focuses on enabling client access to aggregated financial assets through the use of EEI's platforms and architectures. And finally, we have Ryan Christiansen with Finicity. Ryan serves as Finicity's Senior Vice President for Data Access and leads Finicity's efforts on data access agreements with many of the world's largest financial institutions. So I want to thank my panelists all for joining me today. Really appreciate you coming and being a part of this webinar. So let's dive in. And my first question will be for the group. I shared a lot of stats at the beginning of this webinar about some of the changes and impacts that have occurred in financial services as a result of COVID-19. But what have your organizations observed? We'll start in reverse order of introduction. So Ryan, if you could lead us off, that'd be great.
Okay, great. Thanks, Tom. It's great to be here. So I think I want to start off by answering that question by sharing a text I got here on my phone from a friend a few days ago. And he said, hey, applying for a mortgage on blank mortgage. Notice it's going through Finicity. Pretty slick. But where's the love for our beloved blank credit union? And by love, I mean auto connection. Beyond him finally understanding what I do for a living, which he pointed out as well, what that pointed out to me is here's a person I've known for a long time that's always had a traditional banker that he's worked with on all of his financial transactions, including his lending. And through the COVID crisis, he has decided to use a different service. And what were his words? Pretty slick. And he also, called out that it didn't work for one of his institutions. And he's like, man, this would be awesome if it worked for this institution. And I think that's what we've seen here at Finicity is really a demand, an increased demand for the online services, as you pointed out earlier, Tom, is whether someone's digitally verifying their income or assets or just checking in on the state of their current financial affairs. The demand has really increased. In the past, we've seen, a fair bit of tire kickers, if you will, that will come in and maybe try a service, but not maybe go all the way through either, consenting to share their accounts. And we've really seen a higher throughput on those consumers engaging through the whole process and really using the service. So, that's kind of what we have seen from the Finicity point of view thus far.
Thank you so much. Bill, what have you all seen at EEI?
So it's, I'll start locally, from a perspective of my wife didn't want to go to the bank before all this started. And 3 of my 4 kids have never, adult kids have never actually stepped into a branch themselves. And the types of calls that we've been getting from a lot of the banks and from a lot of the fintechs really center around the following, what do I really need to do inside a branch? And is there a way to automate what I used to do inside the branch? And it's been a lot of strategy sessions on things like KYC, know your customer. You walk into a branch and one of the things you get is a visual inspection. Well, if you're no longer walking into a branch and there are certain functions that you just can't do, without a branch, some of them you'll never be able to replace, like depositing greater than $500, withdrawing more than $500, your safety deposit box. But when you really get down to it, what people are trying to struggle with is, all right, how do I set up for my mortgage? How do I set up for a loan? How do I gather in all this information? How do I collect all these signatures? And people have basically verbalized it's just not strong enough. When I do a deal with a client, we'll use DocuSign or EchoSign or any of those services. And why do they work? They work because my signature is coming from my email address, which is a corporate email address. These guys are struggling with, how do I know that somebody's Gmail address is real? Or showing my age, how do you know that that person who's still got an AOL account that it's really theirs? So it really brings up a whole bunch of new security issues and a bunch of new security questions. And how do you automate what you used to do inside with a branch, in the branch, and put that online and really continue to drive that stickiness? One of the stats that you threw out before says, if my local branch closes up, I'm switching branches. So these guys really need to quickly strategize and get on the same page with, how can I know my customer? How can I make sure that when they go to do something online, that it's really, really them? And how do I streamline processes going forward? So the banks need to innovate on the bank side, the fintechs need to innovate on the fintech side, and really a lot of the questions we're seeing is, how do we do that?
Yeah, thanks. I know we're going to dig into some of that here in some next questions, but that was a great lead off. Christina, give us the kind of 30,000-foot view from Consumer Reports.
Sure. So just to kick off, first of all, thank you so much for being here. I really appreciate this opportunity. And people may not be aware, Consumer Reports actually has an in-house survey department, and we do both quantitative and qualitative research. And then we also collect consumer stories from our members. And so when I'm citing numbers, I'll reference that's the quantitative research. When I'm talking about experiences, that's the qualitative research. And if there's ever any doubt, I'm happy to share our public-facing research with anyone. On the big picture, the financial hardships of the crisis are extremely unevenly distributed, and they are disproportionately falling on certain segments of the population in the United States. And that tends to be Black Americans, Latinos, and younger Americans. So what does that look like? So overall, 29% in our survey from mid-May reported that they had lost income or wages, but that number was 38% for Latinos. It was 31% for African Americans, and it was 40% of those under 44. So this means that there's a lot of difficulty in meeting basic expenses. And what does that look like? Well, 8% of Americans reported being behind on their rent and mortgage, but it was 18% of Latinos, 12% of Blacks, and only 4% of whites. So that's the sort of qualitative or a quantitative look at the big picture. What does that look like in terms of financial services? This is where the qualitative work comes in. And we've been doing focus groups since March on the specific financial impacts of the COVID crisis. And some of the things that we've seen is that the people experiencing economic hardship are very eager to access help, and that they're actually not hesitating to reach out for it, which I find quite heartening. There's also a great deal of evidence that service providers are making help available. So that's not just the CARES Act, but there's voluntary efforts there. Now, what are we also hearing? Consumers are having a great deal of difficulty in accessing this help. Now, some of that is for reasons that are not necessarily clear, right? It could be the dispersed, customer service groups. It could be a failure to have those policies trickle down to the front lines. So that's one part of the consumer-facing, like I called my financial institution and I couldn't get through. But we're also seeing evidence on the digital side. So we have anecdotes. This is, again, the stories that we're getting, is that we have stories of people who thought they were enrolled in a deferral or a forbearance, so deferral on their credit card, forbearance, formal forbearance on their mortgage, and they find out only when they get either the past due notices, and that's often in the mail, or they log on to something like Credit Karma and they notice that their credit score has dropped. So big picture, unevenly distributed hardship, smaller focus of the people experiencing hardship, they're eager to get help, and in some instances, they're having difficulty accessing it.
Yeah. It's stunning to hear those numbers, and I think it's important. One of the things that we talked about in our prep sessions as we think about this webinar, not just what are we observing, but what do they mean, to think about how these changes can't be monolithic. They have to address the different needs of different communities. So let's maybe drill down just a little bit into that question, and I'll let you go in kind of whatever order you want to. But I'm interested to know from each of your vantage points, because you kind of sit in different seats, if you had to pick one consumer behavior shift that has occurred as a result of COVID-19 that is the most surprising or most eye-opening, what would it be? And I think the why behind the question is really, there's some of these where you say, oh, well, this naturally kind of sped up the transition that we were already seeing. But what things have been surprising to each of you?
I guess I'll jump in. So the thing I think was the mobile banking numbers. I really didn't realize, and unfortunately, I fell into this category because I love going to the bank. A lot of people actually are not doing mobile deposits with their checks, and it took me about 5 minutes to set up. And I went through and I set up the mobile banking deposit. Then I realized that certain accounts don't accept it and certain accounts do. So I've got to change around a few accounts. Like I said, my adult kids never go to the bank, and they had to help me set it up. And it's not a trend that was just myself. When we spoke to people and we spoke around, all of a sudden there was a surge in mobile signups over 200%. And people really had to go through and deposit checks. A lot of people got their stimulus checks, and a lot of the older people who got them didn't know what they were going to do with them because they were afraid to go to the bank. So I found myself helping out a couple of relatives and setting up their mobile banking application for them, so literally they could deposit their stimulus check. So, I'd agree 100%. It really sped up that part of the market that was hesitating in doing mobile deposits. And now they're all on it and they kind of like it. So I don't really think there's going to be a huge untapped market anymore of people for mobile deposits, but they will be changing some of their account types because things like if you have a traditional passbook account, you can't do a mobile deposit into it. So, you do have to go to the individual banks, and the individual banks will either now lift that restriction or convert those accounts. So there'll be some work on the bank side to go through and enable that.
Yeah, and I would say that, beyond the thing that we've been most surprised about, beyond the fact that almost every account holder in America was repeatedly checking their account balance on the 15th of April to see if they had received their stimulus deposit. That was a pretty big surprise, I think, industry-wide. We've really been surprised by the pace of adoption. And in our seat, what we see is often the aggregate of behaviors as our fintech clients and some of our financial services partners make decisions based on the individual actions of consumers. And I think there was a moment where we were all kind of holding our breath to see what this was going to look like. Are people going to delay investments into some of these technologies that we've been leaning into? And what we have seen is actually quite the opposite, where it's sped up the investments into some of these technologies and really kind of increased the pace of adoption. And kind of go back to my example of every account holder in America checking their account balance repeatedly over the day that it was announced that those deposits were going to be dropped. I think it's exposed some opportunity to think about what it is that we need to do as an ecosystem, such as what is the total capacity that we need to be building to in order to support the consumer's access. And I think that highlights some of the questions that get exposed out there.
I find that fascinating around the checking of the balance. That's actually eye-opening for me, although I do have a different eye-opening response. So in the same way that people with kids versus people with not kids are having very different sort of lockdown experiences, on money, the experiences are very different. So I've focused on financial hardship in my earlier comments, but what I would also want to highlight from our qualitative research is the emphasis that consumers put on saving and a fall off in desire to consume. And I think both of those are going to be very interesting to see if those are lasting trends or if they were driven by a lack of opportunity to spend. There was a lot of glee in the people who were reporting, I'm not spending on going out. I don't have to worry about dry cleaning. I'm saving from not getting my hair done. Like, there was a lot of those anecdotes, and whether that's going to translate into, increased savings and a decline in consumption moving forward is, I think, going to be really interesting. And the sentiment around I've lost my desire to consume has probably been the single most surprising to me.
That is really interesting. Yeah, I when we were doing some of the initial research, looking at this webinar, there was a mix there between kind of increases in fear over general finances long term, and then also a feeling that there was going to be okay because I was going to save and consume less. That's interesting. Christina, let's pull on that thread just a little bit more, and maybe some of your earlier comments. And I know you helpfully broke down for us the two sides of the house of research with Consumer Reports. You're well known for surveying and understanding consumer attitudes about a broad range of market conditions and consumer behaviors. I know you're also sit on the FDIC Advisory Committee on Economic Group Inclusion, so that gives you some perspective on these issues as well. So I guess my question is, what does the broader financial ecosystem need to consider to ensure that digital transitions include everyone? It was super helpful, some of the stats you broke down in terms of how this disproportionately affects different populations. But if there was guidance to kind of the full financial services ecosystem from your perspective, what would it be?
So I think the big picture is that, what's the expression? The future is here, it's just not evenly distributed. And I think that's absolutely true when it comes to digital finance, right? And so the things that people on this call probably take for granted may be inaccessible to some, and I'll talk about my recommendations on that. But I think the crisis really has highlighted the digital divide, right? The difference between even schools. There's a rural school, I live in Sonoma County, California. There's a rural school west of here where the teacher has had to have weekly lesson plans that parents can come by and pick up because internet access is so difficult to come by. So, we're seeing that. I think we're going to see that on an effort to close that gap. And I think that's absolutely critical to being more inclusive. Now, coming in more directly relevant to this conversation, in 2019, Consumer Reports did some research, and again, that's obviously pre-COVID, and fewer than half of the people in that survey were extremely confident in their ability to manage their finances completely digitally. So, that's why that bank transition, if the bank branch near me closed, that I would actually move my money is not that surprising to me. And we're also seeing the continued importance of cash. So, there's this story from the Wall Street Journal yesterday about the difficulty in getting enough coins out there, given some of the lockdown restrictions and then the increased demand as places open up. And 35 million Americans got their stimulus by check. So how can we make this more inclusive, right? I think one of the really important things is to add in accessibility to your digital financial service at the front, right? What does that look like? Well, some of it is about recognizing different physical capabilities. So one of the things that happened this week was Twitter announced voice tweets, but they didn't contact the deaf community before then, and now there's been backlash, right? So I think it's really, when you build these digital tools, to be sure to make them inclusive in that regard. Now, one thing that Consumer Reports also learned in 2019 was what was the single most important feature? Privacy and security, right? Past research on some digital apps, they don't default consumers to have the most private and most secure settings. So that also is another way that you can differentiate your offering, is really focus on those benefits. Now, given the continued importance of cash that I've already talked about, is opportunities to get cash into the system, or to allow for non-traditional payment tools to be included. So if your digital wallet allows for the use of prepaid cards, that's a way to be more inclusive. And then just finally, is speed really matters. So one of the things that we're seeing here throughout the digital ecosystem is difficulty in accessing customer service, right? And the institutions that didn't have phone lines often were the subject of complaint about that. Now, if you can't provide an immediate response, give a consumer a reasonable timeline, because that can lower frustration. Speed also matters when it comes to funds availability and some other things. And then my last push on how to be inclusive would really be about using this data for good. So in the current crunch, right, who's financially struggling. You probably have a pretty good idea of who's going to need a fee waiver, who's behind on their bill, that sort of stuff. And to the extent that the programs are available, deferrals, that sort of thing, auto-enroll consumers at, we've suggested 30 days, and, having a period of fee waivers and that sort of thing. So I think it's really important to meet consumers where they are, and that may be, not where we all are.
Super helpful perspective, and extremely relevant to a whole host of issues that we have all been living in over the last several months and appreciating more about. So really appreciate that. Bill, I want to switch gears a little bit to go to you on this next question. I know EEI works with a lot of financial institutions, help them keep pace with digital innovation. So I'm interested specifically where you think financial institutions will prioritize and will need to prioritize investments coming out of the COVID-19 crisis and reopening some of these branches, or at least making decisions about whether to reopen some branches. And essentially, I think, as you were alluding to in your opening, transition some more of these traditional in-person services to digital services.
Absolutely. I mean, I think there's two layers to the question, and I'll start from the second layer. The first is, with all these institutions, they need to increase the security that they have around these online systems. And, what you'll find is many consumers who are new, they can't handle the complexity of logging in to check their credit card statement, logging in to check their banking statement, and logging in to check their stocks. And what you find is, if these institutions layer too much security on it, and it comes right into something as simple as your password, right? If you make that password requirement that it's got to be 12 characters, you've lost them. If they're forced to use 2 numbers, 3 uppercase, 2 lowercase, when the security gets so bad that the only thing that you can do to remember that password is to write it down, you've really made a huge mistake, and you're driving your customer away. So, what they have to do is they have to figure out, first, when it comes to the passwords they have, make them safe and simple. And a lot of these guys, they talk to the CISO, and the CISO says, we're going to dial this thing up to the most secure thing on the planet. And what you see is, I'm just going to go use a different credit card where it's easier for me to do it. So, how do you address that? Because no one wants the less secure version of anything, right? Everybody wants the more secure version of stuff. And the way to get the more secure version of things is basically, to steal the wealth management term, it's KYC, know your customer. So have them come into the branch once, have them upload their driver's license, have them upload their passport, identify the two, marry the two together. They can, do things where, my password can be safe and simple. So I, get stickiness to that, because I'll tell you flat out, anybody who gives me that verify box where I've got to find the cars or I got to find the crosswalk, the find the crosswalk is the one that kills me. There's 2 levels on find the crosswalk, right? I could keep going till I get all 5 images right, or I can click until I've made them all go away. You have to understand, and this goes into what Christina was saying, if you don't have a level of sophistication, you need to keep it simple. Believe me, no one is spoofing those images. And after I've clicked 4 of them correct, I just get frustrated, long term on it. So, there's the whole security aspect to it. When people come into the branches are going to have to behave differently. There are some branches out there that went, why do you like going into the branch? Well, they don't have the glass and they don't have this. And I felt like, it was great that I could go in and have interaction with my teller and, with my loan officer. They've got to rethink that now because people, are going to gravitate to the ones, that were old style where there was all this plexiglass. And it wasn't just plexiglass, it was, 3-inch thick plexiglass. So they've got to do a couple of things in the branches to really modernize how they want to do it so you feel comfortable coming in. But the idea is going to be when you come in, you're going to come in once. So if I want to go fill out a loan application, get my driver's license, get my passport, get the things that you need to, do with me. And one of the interesting things that we've looked at is even maybe your bank is going to give you a bank email address. And why would the bank give you a bank email address? Now they know they've verified exactly who you are. When you have to give identification or you have to be sent a document for you to sign, it's not going to AOL, Gmail, whoever the flavor of the month is, or, BillTrapani.com. It's going to their institution's subset of email. And again, I know one of the things, one of the costs was a blocker, right? If I have to give an email address to every single one of my customers, what's my cost? But it doesn't have to be a full-blown email address. You're not looking to do your consumer shopping in it. You log into that when you need to sign documents for the bank. So there's a lot of strategies we've worked with on the bank so far and with the wealth managers. We're stealing that concept of KYC. And I don't want to say dumbing it down. What's going on with KYC is really simplifying KYC for the banking industry and for the credit unions and making it so it's very much accessible and it's very easy for no matter what your economic status is, that you understand how to go through and conduct a banking transaction, how you understand how to go see what's going on with your credit card, and a way, that's coming that you take all these, some of the people didn't get checks, some of the people got, debit cards. My in-laws are in their 70s. They got sent a group of debit cards. They've never used a debit card in their life. So now they've got all this money sitting on a debit card, and what they really want is cash. So, how did they get the cash? At the end of the day, they gave me the credit card, I gave them the cash, and I went out and spent it on the debit card so they could do that. So you've got to figure out a way to convert that debit card into an account, into cash, to make that whole thing flow better for people who just aren't going to accept it. And it's not the millennials, but there is a significant part of the country that's never going to embrace that new digital. They're going to be here, God willing, for another 30 or 40 years. So, we've got to solve that and cater to them a little bit. And on the youth coming through, I don't know if I feel comfortable handing a 19-year-old a debit card with $1,200 on it. I certainly don't. It's too much cash, too much for them to go through and get in trouble with. So I think you see the different layers that are out there, but when it comes into how do these banks and how do these fintech apps provide a greater level of security without completely frustrating their consumers so they can drive that stickiness to their institution or to their brand. I'm going to go to use the bank's products or the credit card that I can most easily get into their system, most easily see my transactions, and most easily get out.
Yeah. No, another great list of things that I know we've got a lot of folks probably taking a lot of notes now, and we'll come around the circle. Well, first, we clearly have our next webinar topic: who came up with the crosswalk in the Captiva authentication piece there. It's a great question. All of us can relate to that, I know. Let's come fully around the circle. Christina gave us a great perspective on kind of inclusiveness and ensuring that any of these changes work for everybody. Bill, you've given us a great perspective on kind of financial institutions and how they need to be thinking and what you're seeing. Ryan, let's come maybe around to complete the circle, and I think this really goes to a lot of the work, obviously, that FDX is working on with transitioning things over to the FDX API. All of this innovation, all of the digital transformation that we're witnessing is both kind of the speed of light and exciting. But I guess my question for you and from Finicity's perspective is, are there still gaps when it comes to helping consumers leverage their own financial data? So if they want to use these tools, maybe kind of past the 101 level, what do we still need to do to ensure consumers are able to interact digitally and truly get that kind of end-to-end connection to the services that they want with their own data?
Yeah, thanks for the question, Tom. I think I would highlight 2 points here, and I'm going to go back to my earlier stimulus check example for one of my points. If you go back to that, I think there's a couple of lessons we can pull out of that, and that is that consumers often use technology for discrete and ephemeral purposes. And so, as an example, as people are checking their balance, what they really needed was a moment in time update on their account information or an event. And so we should be thinking about how to have event-based notifications that can be used at both the application level and the FI level. Because what we were effectively doing in that example was we were tying up an entire platform as consumers were trying to get information on a single event. And I think this highlights the opportunity for the financial institutions or the data custodians and the fintech applications and data aggregators to work together. And so if you think about how to serve consumers, we've had highlighted that there's various distinct user groups out there, right? I mean, the great example of a voice service that wasn't really vetted with the deaf community. And so if you're a financial institution, a very large financial institution that has lots of consumers, you may not be wanting to make an investment in some of these niche markets, but there's probably a fintech app out there that's very interested in that niche market, and they can build out services that will serve that market. And the financial institution doesn't necessarily have to make that investment, and they can still serve that market. So there's really a symbiotic relationship that occurs out there, and it requires all parties to have that symbiotic relationship. And I think another example is that was referred to earlier was you may have an overdraft event coming up, or you may have a payment that's coming up, or it's gone late, and that's an event that's happening that we can be sending notifications, or we can be giving more discrete information to the consumer to help them make better choices. I think my second point here is that we really need to unlock the potential of data. All organizations that we work with, and all of us work with, they use data to unlock potential. And so what we need to do is to make sure that we are doing the same for consumers. And that means, one, they've got to have access to all their data. And two, it needs to be done in a manner that consumers trust. And that means it's got to be done securely. It's got to be done in a way that is traceable and has the privacy wrapped around it. So, I would say that's maybe some of the gaps that are existing out there right now.
Super helpful. So I think what you're pointing to is we are making progress, still work to do. So let's circle maybe back. I've got 2 more questions kind of for the full group that we'll handle. And we'll just ask anybody to mute their line if you can, please. 2 more group questions. I know we've already got a host of questions in the chat privately. I'll just remind folks that if you do have a question, please submit it privately to me in the chat function. And we should have some time to get to most of those here at the end. But for the group, and I really think this is kind of the million-dollar question, certainly kind of what we built this webinar around, is what does any of this mean for the future? So what all the observations that we've made, whether it's kind of the broad kind of consumer behavior trends that we're seeing, even some of the surprising ones, the spike in digital access, the transition from a lot of traditionally in-person financial services to digital. Are these going to just be the momentary spike on the radar, and then kind of the pace of innovation will largely continue as it was before? Or has this really changed the trajectory and the implementation of these changes in a way where the graph just looks different now to come to market because of COVID-19?
I'll jump in first. Sorry, Bill, go ahead.
Well, one place that people were absolutely unaccepting in the beginning of this was with credits. Essentially, when you go into a market and you pull out your credit card, that hold goes on your account literally in what seems like sub-second time. And what you found was in March, as things were getting canceled, people were flipping out that they weren't getting their credits and seeing it on their statements. And the banking institutions have been able to, for years, without question, say, hey, it's going to take 2 to 3 billing cycles to see that credit. It's going to take 10 days for the credit to appear. And consumers have been screaming, why? As long as there's been credit cards, why does it take so long to get a credit? And quite honestly, from a technology perspective, it's mind-boggling to me, right? And I've always been the same way. Like, why does it take so long for that credit to get back? I mean, it's just the opposite transaction. If I can put a hold on a credit card that fast, I should be able to give a credit back that fast. And that's not something that's going to change. I mean, that's going to be a permanent change that you see. So to give the greatest example that I can see of, a company that jumped all over an issue and corrected it going forward would be United Airlines. So United Airlines, back in March, if you had to cancel flight reservations due to COVID, you had to go through, you had to request this, you had to request that, you had to open up a case, you got a case, and in 7 to 10 days or 2 billing cycles, you either got an electronic certificate or you got your money back to your credit card if they canceled the flight. Great. Consumers had nothing better to do, but like Ryan was saying earlier, check, is it there, is it there, is it there, is it there? And what we find now is if you go to United.com and you're forced to cancel something, that electronic certificate comes back within 10 seconds. So clearly, consumers now have voiced their opinion that they're no longer going to wait 2 to 3 weeks for a credit. Clearly, this is a technology issue that can be addressed internally in different places. And clearly, United Airlines, not giving them a plug, but just saying they did it and I saw the experience. So I don't think anybody is going to give any of the major retailers, the major credit cards, anybody a break anymore when it comes to how quickly you get your credits back. So I think that's a change that's here to stay. I think it's easily addressable in probably 98% of the cases, and I think you'll see it addressed. And it was something that would have been done, in the future that's done now.
Thanks, Christina. Ryan.
I'll jump in. I think that it's a little early. My crystal ball is very cloudy, just going to be honest, and my magic 8 ball is telling me, maybe on a lot of this stuff. Again, I think the experience is going to be very different depending on the product vertical. So not just the difference for, going forward for people who experience no economic hardship versus economic hardship, but I think some of the information that's out there on mobile payments, again, as we've heard on here, right? These are very different verticals and they have very different stickiness. And I would imagine that as these things prove their utility, we see more, it probably won't be that hockey stick, right? It'll probably be more gradual. but old habits die hard. And, the opportunity to get comfortable with hands-on assistance, as has been talked about by the other speakers, I think is really critical. And if that's lacking, right, some people are experiencing the lockdowns alone, is, that there may be a big difference there. So I am not going to make any sort of proclamation other than the hardship will persist. And again, I'm concerned that it will fall out of public attention. To cite one piece of quantitative data across the board, consumers thought that $1,200 just wasn't very much and wasn't going to be enough to help people who really needed it survive the crisis. So I don't know what that'll mean longer term, but I think on digital financial products, we'll continue to see this urgency around immediacy, immediate information, immediate access to funds, that sort of thing.
Thanks, Ryan. Any thoughts? And then I've got one last question. Yeah.
Yeah, you bet. I think that we've already seen the change adopted by large groups, oftentimes largely focused in the millennials and Gen Zs, right? This adoption's happened pretty rapidly with some of those groups already. But as with anything, there's a bit of a time frame that it takes for old habits to die. And I do want to share a little story about a boomer in-law that I have. And years ago, I convinced him to get a credit card to make his life a little easier. And he got his credit card in the mail, and then he promptly walked down and locked it in his safe because he thought that was the right thing to do. So the first time he used it, he decided to take it out of the safe for a road trip to Alaska. And unsurprisingly, the card was rejected the first time he used it because it's been sitting in his safe. And the first time it was used was, in a different state than where he is living. And so he promptly jumped in the car and drove all the way back from Alaska to walk into the branch and say, hey, my account's been compromised. What do I do? Right now, it took some learning with him to, say, here's how a card works. And now he's happily using his credit card, like all of us in this time of COVID. But he's made that transition. And I think what COVID has done is really kind of accelerated that learning curve. We've had to become very comfortable, very fast with some of these technologies in some instances. And so it's become a forcing mechanism. And I think what we have learned overall is that generally speaking, that when consumers accept a new technology or service, they rarely go back to previous generation tools. So I think that many of these changes that we've seen are probably here to stay.
Got it. All right, I'm going to ask one last group question, and then we're going to try to squeeze a couple of these audience questions in. So I'll ask you to kind of wrap up your thinking, and this is kind of to give your counsel to our audience, and certainly to those who will be watching kind of after today. But when you think about all these things that we've been discussing, what's ahead for the financial services industry in terms of the transition and transformation really being put kind of on hyperdrive, my question is, what mindset does a financial services company, whether they be an FI, a fintech, a data aggregator, somebody else in the universe of financial services, what kind of mindset do they need to have to be prepared for what's ahead, and not just for their business, but truly to serve the consumer? I'll try to put you on a 30-second time clock each to go on that one.
I'll go first. First, I would say is the mindset should be transparency. Am I as transparent as I can be? The second is, am I making help available as easily as possible? And then the third is, how am I holding myself accountable for making sure that this help arrives?
Crisp, I like it. Ryan, Bill?
Go ahead, Bill.
I would have to say it's, it goes into those things that you have to do multiple times a day. And, a lot has been talked about, checking things. And I know that, like the one that, drives me nuts because I understand the industry is when people log in multiple times the same day to check their 401k balance. not realizing that their 401k balance never changes during the day. So I do think when it comes to all of the financial services products that are out there across the board, from your credit cards to your banking statements to your 401k to your stocks, you really just need to explain to people a little bit better what the update period is on a lot of these products, what does it actually mean, and that doesn't get fully explained to the full range of people. They just don't understand that, a debit takes place instantaneously online, but a credit might take X number of days, and the stock market could be up 3,000 points, and you can go to check your, you can go check your 401k, but that balance doesn't change until the next morning. So, there's a education thing that needs to go on for people so they understand the timing of different financial products. And once they understand that timing, I think their lives will get a lot simpler, because now they're really going to be forced to do everything online across the board. And everybody wants to now embrace the fact that, paperless statements just got a big boost in the arm, right? So, no, I know people who don't want to check the mail or who wipe down the mail and, all this other stuff. So in lieu of my statement, I really have to understand what's going on online.
Yeah, and I would say that from my perspective, we're a digital transformation company, and what our advice is that you need to think about there's doing digital and there's being digital, and which kind of organization are you going to be? And if you're going to be digital, that means you've got to have a deep understanding and commitment to the customer experience and their expectations. And what I would call out there is that the CATS principles of FDX, which are control, access, transparency, and traceability and security, are very much in line with consumer research that shows the expectations that consumers have.
Yeah, I really like that. Be digital or do digital. It's a great takeaway. We've got a couple audience questions I want to try to get to here. We just have a couple more minutes. So the first one, this is one I actually thought of when I was doing the research, but how much so we're talking a lot about kind of some traditional financial services, especially when it comes to financial institutions and thinking about branch-based services around account opening or check cashing and the like. How does the Venmo, PayPal, Zelle economy impact this? I mean, where you've got this movement kind of almost exclusively in a lot of senses to some of those tools. Can you speak at all to kind of how that impacts some of these ongoing changes?
I could probably add something really quick. One thing we think about oftentimes is if you're using a Venmo or a Zelle or something is, it's from a consumer standpoint, you see that there's a Venmo payment or a Zelle payment, but what's the details behind that? Who was the recipient on the other end, or some of the details that we're used to seeing in bank transaction level? Because with those details, you can continue to empower the customer by giving them more data that's associated with that transaction.
Yeah, from my perspective, strictly speaking, when it comes to things like Zelle and PayPal and stuff like that, you actually find out a lot of people in the industry don't like to use those types of products. And the reason for that is your credentials are being passed around between multiple vendors. And, I know among the fintech community, it's not a popular stance, but it is a reality that, username and password, for authentication must die and tokenization must be adopted. And the reason for that is, to actually go through and use PayPal or use Zelle or do something meaningful, the amount of things that get done and the amount of layers are passed. If I want to go from my bank to your bank and they're two different banks, there could be anywhere from 4 to 6 hops of credentials being passed back and forth. And I think that, as people are more educated, the first thing they come up with is fear. Who knows my username and password? And, there's a lot of FUD out there in the world as to, what is really secure. And, the banks understand that they need to move to OAuth as quickly as possible. The fintech community understands they need to move to OAuth as soon as possible. and there are a lot of older applications that need to get upgraded to handle that. So, when you use these products, it seems so easy, and the millennials are very much more trusting than the boomers are, or the people caught in between.
Great plug for the work of FDX. Bill, thanks. We didn't even pay you for that, but exactly what we're doing, so thank you for that. Christina, I'm going to give you the last word on this question.
The only thing I was going to add is we're seeing a lot of interest in these types of payments for areas that could easily be vectors of fraud, and the Craigslist sale, the garage sale, the tipping of a total stranger, and so that's just got me a little bit nervous because we always say use these services only with people you know and trust, and that's always the best advice, and it's a little bit distorted in this environment.
Yeah, that makes a lot of sense. Well, I wish that we have a few more questions in the queue. I'm sorry that we can't get to them. I know several of you have other calls that you're jumping on here in just a few minutes. So I want to thank all of you for joining. Certainly thank our panelists. This has been a really cool discussion, and certainly even beyond my expectations when we started planning this out. So Christina, Bill, and Ryan, thank you so much. For those of you that are joining us today for the first time or unfamiliar, again, please do visit us at financialdataexchange.org. Follow us on Twitter and LinkedIn. We'd love to have you come join our ecosystem. Bill gave a great plug for exactly what FDX is trying to do to move away from those held away logins and passwords and to secure and common data sharing via the FDX API. So thanks again, and we look forward to seeing you all on our next quarterly webinar, which will likely be in the early fall of this year. Thanks again, and bye-bye.
Thanks, Tom.
Thanks, Tom.